Hello, my name is Jingonelli, and for today we are going to be looking at an example which was done in class on reducing balance method by Mr. Kasim. So with this, the reducing balance method can also be called the diminishing or declining balance method, and under this method, more depreciation is allocated to the earlier years than to the later years of an asset. So what do they mean here? They mean that depreciation is charged as the asset gets older. So this is always suitable for assets that are more useful in the earlier years than in the later years. For example, the automobiles. So under this method, depreciation is always charged on the book value. You can call it book value or carrying value at the beginning of the year and not the original cost. So we are not going to look at the two types, so we move on straight to the example which was done. So let me zoom in a little. So with this, they're saying a computer was purchased on 1st January 1991 at 2 million. It was then sold or disposed of on 31st December 1993 at 1.2 million. So provision for depreciation is at 10% on reducing balance method, and they're saying a full year's depreciation is charged in the year of acquisition and none in the year of disposal, which was our year of disposal. Our year of disposal was 31st December 1993. So and our full year of and our year of acquisition was 1st January 1991. So that means they're going to charge depreciation in this year, and the only year which they're not going to charge depreciation is the year of depreciation. So they're going to charge in the year of acquisition, and here we are seeing that they've said required prepare the computer account, accumulated depreciation for the computer account, then computer disposal account. So with this, the solution is we are going to be having our cost, which was this when the computer was purchased, and we're having our years. Remember, they're talking of year of disposal to be 1993. So I'm going to look at years 1991 and 1992 because they're saying a full year's depreciation is charged in the year of acquisition and none in the year of disposal. And this is the year of acquisition, 1991, and we just have to go along with 1992 because they only talk about the depreciation not being charged in the year of disposal, and that was 1993. So it's what we are not going to include. So I want you to look at this note. When using reducing balance method, depreciation for the first year, this first year 1991, is determined as the provisional rate. What was our provisional rate? It was depreciation for the provision for depreciation, which is 10%, times the cost of the asset, which was 2 million. So for the first one, it's going to be the 10%, which I did here, times the 2 million, giving me the depreciation expense of 200,000, which I did here and I labeled it as my A. So after doing that, accumulated depreciation, I'm going to just get this 200,000. I automatically put it here as my first accumulated depreciation of my depreciation. So once that is done, when I want to determine the net book value is going to be cost minus accumulated depreciation. So when I get the 2 million minus accumulated depreciation, which is 200,000, it's going to give me 1.2 million. So having known that, that's when I read this other note here saying in the subsequent years the depreciation expense is the rate times the net book value. So in the other years, subsequent years, which is 1992, the depreciation is to get the depreciation expense. This depreciation expense you're going to get at the rate which was 10%. So it's going to be 10%, which is this, times the net book value, which is 1.8, which is this 1.8, to give you 180,000. So which is going to be this, which is going to be 180,000, which I've labeled B. So when I come to accumulated depreciation, since I'm dealing with a subsequent here, it's going to be the first depreciation expense plus the second depreciation expense, which is equal to the 380,000. And having done that for the cost, I already told you it is cost minus accumulated depreciation. So it's going to get this 2 million minus this accumulated depreciation of 380,000 to give you 1.6, to give you 1,620,000. So once that is done, I've finished doing maybe my table, and I've done everything. I come back to the question saying prepare the computer account. So for the computer account, remember we purchased this we purchased it at on 1st January 1991, so at 2 million. So meaning that having purchased it, remember, to complete double entry, we are going to purchase this item, this asset, and we are going to pay cash. So if at all we were having a cash account somewhere, this will be the debit side and this will be the credit side. So we are going to come on the credit side of the cash account, and we say computer. We paid we purchased a computer of 2 million. So once this is done, you have this in your head that they have credited the cash account to show that it's reducing. The cash account is reducing by 2 million. You go to the debit side of the computer account, which is this, to complete double entry, and you say 1991 January 1st you received cash, you paid cash to purchase this the computer, which is the asset. So meaning you paid cash of how much? Paid cash of 2 million. So I brought in this side account to show you how the cash came in. So after you crediting your cash account, you come on the corresponding remember every debit must have a credit side, or every credit must have a debit side. So this credit side must have a debit side, which is this on the computer account. So once that is done, you're going to say then on 31st December of 1991, you're going to be having a balance carried down. So the balance carried down will be the same amount, which is the 2 million. So once you're having this a balance carried down, you just cross over. You take it, you go this side on the debit side, and you record that. So this amount here is going to be your opening balance in 1992. So January 1st 1992, you're going to be having a balance brought down. You're going to be having a balance brought down of 2 million from 1991. So you just cross over and then you bring it this side. So this is going to be 2 million, and after recording this 31st December of 1992, we are going to be having a balance carried down of the 2 million, which is this, which I've recorded here. So having recorded that, because here we are looking at the computer, the computer account before it was disposed of. So providing you're having more years, you do the same for the other years till you reach that year of disposal. So you know that in 1992, that's when it was in 1992 it was not yet disposed of. So you're going to still carry this balance carried down to the next year. It crosses over. So in 1993, this is going to be your what? Your opening balance. So which is the balance carried down of 2 million. So once this is your 2 million, you know that in 1993 in 31st December, that's when they disposed of this asset. So you're going to go on the credit side, and then you dispose, and you say 31st December, since it's our year of disposal, you're going to say 31st December disposal of the asset, which is 2 million. So with this 2 million, once you have disposed, you have indicated that it was disposed, that it was disposed of to the disposal account, you just get this amount here. Still it will cross over, but it will cross over to the disposal account. So if at all we are to draft a disposal account somewhere, this is the figure which you're seeing here on the debit side, because this side it was recorded on the credit side. So upon taking it to the disposal account, you treat it as this 1993, and it was December 31st. That's when you are disposing of this asset, and you took this amount on the debit side. So having known that, having recorded that, that will be the end of the computer account, preparing the computer account. Now looking at the accumulated depreciation for the computer account. Now with this, I want you to always remember this. You always you debit the depreciation account, and then you credit the accumulated depreciation. This is more because depreciation can be looked at as an expense, and with an expense, you know that is an asset, so you debit. And with accumulated depreciation, since it's reducing an asset, and the depreciation is accumulating, so it means that we shall credit it, because an asset reduces by crediting. So you may take those reasons to why you're debiting and crediting. So looking at the accumulated depreciation, remember I told you debit depreciation and then you credit accumulated depreciation. So you automatically come on the credit side. You automatically come on the credit side of the accumulated depreciation for the computer, and then you say 31st December. And then you say 31st December, there was depreciation. So you go back, December 1991, there was depreciation, and we know in our first year we had a depreciation expense of 200,000. So that is what you do. You go on the credit side, you say depreciation of this. Then what will happen? Remember, if I told this has been your opening, then this will be the closing, which is a balance carried down. So you say 1991 December 31st, it will be having a balance carried down of 200,000. Remember, with things to do with things on the credit side, things like liabilities, things like incomes, they get to have a normal credit balance carried down. So once here you're having a balance carried down of 200,000, so you have a balance brought forward. So meaning that remember, things on the credit side are having a normal credit balance brought forward. So here you'll be having your credit balance, which is 2 million still. So this will cross over to this side. So in 1992 you're having January 1st as your opening balance carried down of 200. Then what happened? Remember I told you debit and credit, and with accumulated depreciation it starts with remember you have to credit it, so you just automatically go on the credit side. So you're having depreciation 31st December, and then you get to look for your depreciation expense, which was 180,000. So you just come and put your 180,000. So you adding the 200,000 plus the 180,000, you'll be getting 380,000. So it's this 380,000 you balance out off with this side, and then when it comes on the debit side, you will get to say 1992 December 31st, then the balance carried down will be 300,000. so that the two sides can balance off. So I told you with this it will just cross over and it goes on the it goes on the credit side of the next year as you're opening as an opening balance. So in 1993 it will be Jan 1st, and then balance carried down of 380,000. And then remember, this is our year of this of disposal. In 1993 December 31st, that's when it was disposed of. So you show that it was disposed of, and it has to be taken to the, now you're transferring the accumulated depreciation to the disposal account, which is 380,000. So with this you will always debit the accumulated depreciation and then credit the disposal account. So here you can see that the accumulated depreciation is being credited, which is this. You debit the accumulated depreciation. So this figure is on the debit side of the accumulated depreciation. So here the reason, you transfer the accumulated depreciation of the asset. You transfer the accumulated depreciation of the asset to the asset being to the asset to the to the asset being disposed of to the disposal account. So this figure, it's going to just cross over. You are crossing over this figure to the debit side. So when I open up, remember my computer disposal, they also asked me to open up a computer disposal account. So my computer disposal account, in that year of 1993 31st December, I'll get record December 31st accumulated depreciation of, so I was having, remember it crosses over, the 380,000 goes on there, that is the credit side of the disposal account, which is 380,000. So remember in the question, and I already showed you how we recorded this, the computer. It was from the computer account, which was this. When it closed, they were closing it off to the disposal account, it crossed over into on the debit side of the computer disposal account, which is this. And with this one, accumulated depreciation, that also crosses over. Remember, we had ended with the disposal this side in the accumulated depreciation account, and it crossed over, it went this side. So you know we have gotten this 380 and this 2 million. So now the cash is coming in from the question where they say he disposed, but he disposed on 31st. He disposed this asset at what, 1.2 million. So you want to determine whether there was a gain or a loss on disposal. That's why we open up this computer disposal account. So you know, from double entry, and also like to get to record this figure, you're going to say if at all they disposed of this asset, they must have gotten cash. So you'll be having a cash account somewhere. So this cash account, you come on the debit side of the cash account and you say cash is coming in, and you increase by 1.2, and then you say the corresponding credit side will come on the computer disposal, which is the cash, which that's where this cash is coming from. So when you go on the credit side of the cash, you say cash 1.2 million. I hope you have gotten where the computer disposal account is being credited with the cash. So once you have debited cash somewhere, you will come on the corresponding credit side to record the transaction of cash, that they were able to receive the cash and of the disposal, and on the computer disposal account you get record cash as 1.2 on the credit side. So the entries will be debit cash, then credit disposal account, and it's what we have done here. We have credited the disposal account by this, which is 1.2. So after having known that, you'll be having this figure 380 and 1.2, and also this 2 million. So you determine which side is bigger to determine whether it's a loss on disposal or a gain. So you realize that the debit side is more. So when the debit side is more, you bring the 2 million and also the 2 million. So you find the difference between, you first add 380,000 plus 1.2 million. So you added these two. Then after adding the two, minus the 2 million. So 380,000 plus 1.2 million, then minus the 2 million. You are going to find out that this side is going to be having the difference of 420,000. So this is the loss on disposal. So when it is on the credit side, it's a loss on disposal. But once you find out that the balancing figure is on the debit side, that will be a gain on disposal. So whether it's a loss or a gain on disposal, you transfer it to the profit and loss account, which is the same as the income statement. So this is what I did. Loss L on disposal, you debit to the profit and loss account as an expense, and when it's a gain on disposal, you credit the profit and loss as miscellaneous income. So basically that was what we handled in class with Mr. Kasim. Thank you so much for watching. Make sure you subscribe on the channel.